What is market structure in Forex, and why it's so important, and why we need to know about market structure and price action. In this video, we will learn about market structure and price action strategies. Hello guys, my name is Shah and you are watching your own Forex channel, FX Shah. So let's start the video. Today we will talk about market structure. This is the basic and the most important component on trading. If you don't know about the market structure, you are not able to be a profitable trader. In this video, we will talk about what are the most important market structures, what can be a price actions trading strategies, and how we can achieve a profitable uh, trading scenarios in the longer run. So if you know about the market structure, that's good. If you don't have any about the market structure, so you will learn from the basics. And if you already know, as I told you guys, so you can get some more points which will help you guys in the future. So let's start. Uh, there are three type of market structures. One is bullish trending market, right? Second is bearish, which called bearish market structure, and one is consolidation. So first we will talk about the bullish market structure. The first one, as we talked, will be a bullish market, right? And we can represent this as a green bullish market structure. So in the bullish market structure, what are the scenarios? In the bullish market structure, we get move to the upside, which are this moves, right? This is a bullish market structure on which we get higher highs and higher lows. So this is a bullish market scenario on which we get higher highs. This is higher high and this is higher low. And if we combine it using trend line, so we get a trend line like this, on which we get an idea that the market is trending up. So this is scenario one. And second scenario, we get a bearish market structure, which represents is red, on which we get an opposite moves, right? So in opposite moves we get lower lows and lower highs, right? This is a bearish market structure. These are lower low and this is a lower high. So this is a bearish market structure, and it's also called a trending market. You have a specific direction to the upside or a downside, so that's why it's called a trending market, right? And third type of uh, move called consolidation, right? Consolidation contains move between a range. I will give you just an idea. This is a consolidative market, right? This is a consolidation which called a range market. This is a range market and the price bounce between high and lows. So this is a scenario of consolidative market, range market, right? So what is the difference between bullish bearish market, and what is difference between these both, which are bullish bearish market and range market? We will talk about in depth in these two scenarios. In bullish market, when we get a move to the upside, which is this bullish market, so the first move, which is a steep and quick move, it's called an impulse. This move, which we are getting, called impulse. And the second move, which we got in the form of corrective structure, it's called correction. Corrective structure. So in the similar scenario, if we got a move to the downside, which is a steep and big move, it's considered as an impulse. And another move, which is a retracement, is called corrective structure. So every move in the direction of a trend is called an impulse, and any move which is against the trend is called a corrective structure. So bullish market and bearish market, which create higher highs and higher lows in the form of bullish market, and lower lows and lower highs in the form of bearish market, consider is a trending market, which is move to the upside or move to the downside, right? Both are trending markets, which is only 10-15% of the overall time frame. Let's say in the 1 year we can get 10 to 15 or maximum 20% a trending market, and 80% of the time we get a range market, which called a consolidative market, on which we get a complete corrective structure. As a whole, it considered is a consolidation and corrective structure, but between inside the range market, we get impulse and correction. But overall, the main uh, trend considered is a range market. So that's why we called is a range market, right? So in the start, if you know what is the difference between trending market versus trading range market, so that was the main difference. In the bullish and bearish market, we get a proper trend, and we get an idea that how we can trade in the form of direction. In the range market, we get an idea that we can get between two ranges, right? If you are an investor, so you follow the long term trend, and if you are a simple swing trader, so you trade from one swing to the another swing in the consolidative market. So that was a basic concept about the bullish bearish market structures, and also a range market, which is also known as a consolidative market. Now we will go to the uh, live market example, gold, based on a gold USD, and I will show you guys that which part is a corrective structure and which part is a trending market. So we will remove the drawing tools so we can get an idea. If we go to the monthly chart on gold, as you can see, the market is trending up, but the price action is not that much, so we will go to the weekly chart, right? In the weekly chart, if you look here from this swing low this till this swing high, as you can see, we get a low higher highs and higher lows, right? This is lower, higher low, higher high, higher low, higher high, and we form higher low, and we can expect another higher high, right? So this is the example of a bullish market which is trending up. Now, if we consider this move, which is this move, we can consider this is a trending down market on lower time frame. As a overall, this is a consolidation for this market. This bullish run, it's a consolidation is overall, but it contains two moves in a lower time frame to the upside and the downside. So what are the scenarios in this move? We are getting lower low, lower high, lower low, lower high, and lower lows. And after this breakout, we get another trend, which is a bullish market trend in the direction of upside, right? So we can call this is a bearish market in a lower time frame from this swing high till this swing high, right? From this swing high till this swing high, we can consider this is a bearish market, and we can consider this is a bullish market. So we will color this red, and we will color this uh, red, and sorry, this will be the green one. So this is an example of a bearish trend, and this is an example of bullish trend, but these are in a lower time frame, which we can consider as a daily chart. In a daily chart we have a bullish market, in a daily chart we have a bearish market, and here we have a structure change. But if we consider moves in the weekly chart, so in the weekly chart, if we have a move, this is an impulse. If we consider is 1 2 3, and if we consider is 4 and we consider is 5, labeling doesn't matter, but just to give an idea. So this overall move we consider is a consolidation, as I label it is, for example, W, X, and Y, which is a part of consolidation, we can consider as a correction for this whole move. So now you guys know that every time when we get higher highs and higher lows, there is a bullish market, and whenever we get lower lows and lower highs, that considered is a bearish market. But whenever we not get any lower lows, lower highs, or higher highs and higher lows, that market consider is a consolidative market, right? So in every time frame, if you are trading 4-hour chart, in a 4-hour chart you can get a uptrend, but if you are trading one daily chart, that 4-hour chart trend can be a consolidation. So it's totally dependent on the time frame which you trade, so you can get what time frame has which type of trend. For example, I show you guys that this is a weekly chart. In a weekly chart, we have an uptrend, and currently we are in a consolidation, and we are trading between range. But this is weekly chart. If we go to the daily chart, as you know, and you can see that in the previous years, from 2011 till 2015, it was a downtrend on daily chart, and after 2015, in the mid of July of 2016, we get a market structure change, and now the market is going to the upside, which is bullish market structure. And we have also a bullish market structure on a daily, which has a confluence that we can get a move to the upside. So this is the whole scenario. We have currently all three market structures in this chart, and I explained every aspect of bullish and bearish, as well a consolidative market. Now we will talk about how we can trade it. So for example, if we have a bullish market, right, I will talk about the current daily move from here till here. So if we have a move like this and we are trading, this is move. So each time when we get a retracement, so each time on a retracement we enter based on our strategy and we trade the direction side. Majority of traders use Fibonacci levels. Some traders use chart patterns. Some traders use candlestick patterns. So it's totally dependent on your strategy, what you are using for entries. Some traders will use Elliott wave theory, some will use Wyckoff, some will use Dow Jones. So it's totally dependent on your strategy and trading plan and your historical data backtesting. That what are your criterias and what are the setups you are looking for in entering to a trade. In the next video, we will talk about the entry part and greater details. So stay tuned for that. And for now, as you guys get an idea and now you know that what are the market structure and how we can trade it. That's it for today. I hope you liked it. If you have any question or any concern about market structure, please let me know. I would love to get back to you. And stay tuned for upcoming videos. Tomorrow we will do market analysis on gold, so also stay tuned for that. And if you are new to the channel, please don't forget to subscribe. So see you in the next video. Have a great day. Bye bye.